So there was something that actually wasn't said at the Federal Reserve's meeting today that will impact rates in the future, possibly, maybe. So if you hadn't heard, the Federal Reserve raised the cost to borrow money to 0.25% or 25 basis points if you want to sound smart. This is the 10th straight time they've done this in over a year. If that sounds like a lot, that's because it is. So now the cost to borrow money for the banks is between 5% to 5.25%, and they pass that savings along to you. So in today's episode, we'll talk about inflation, where rates have been, where they are now, and where they're going. Let's get it. Welcome back to House Rich, the first time home buyer show where we help millennials figure out how in the world do I buy my first home. Today we're talking rate hikes. So this is what the Federal Reserve did not say during their meeting today. The committee anticipates that some additional policy firming may be appropriate. How do we know that they didn't say this? Because they've said this at the end of basically the last 10 meetings. And after the last 10 meetings, every other meeting after that, they increased the cost to borrow money. So it seems like this was purposely left out to maybe insinuate that things are getting better as far as the goal, which is to achieve the 2% inflation rate. Right now, we're at about 5%. I'll get to a chart later on in this episode. What is the cost to borrow money? It's the benchmark rate. So when you hear that like 5 to 5.25%, that is the cost for banks to borrow money. And of course, banks are businesses. They want to make money. So if it costs them 5% to borrow money, they're going to pass that additional cost on to you. That's why rates have gone up so quickly the last year. And this directly impacts short-term lending things such as like credit cards, which indirectly impact long-term lending such as mortgages, which is what you're probably concerned about. As you can see on the chart, there's been a drastic increase in the cost to borrow money. So if you look back in the early 2020, 2021 timeframe, you see that chart is so low and the cost to borrow money is all the way down near to like almost 0%. It was not 0%. And remember what happened during that time frame? The economy was in chaos due to COVID. No one really knew what was going on. And so in order to prevent like a panic in the economy, the Federal Reserve lowered the cost to borrow money, and therefore interest rates were super low. So that's why you heard those 2% and 3% interest rates. And what did that result in? It resulted in a huge spike in demand for mortgages. That demand increased the cost to buy property. If you just think about your basic supply and demand chart, when the demand goes up, the price goes up if the inventory stays the same. And here's the thing, inventory actually decreased during that time frame. So it was a perfect scenario as far as home prices escalating like they have the last couple of years. So once again, this chart pretty much is almost straight up. If you look from basically early 2022 when the rate hike started all the way up to today, as you can see, we're at 5.25%. Here's a quote from Jerome Powell. A decision on a pause was not made today. However, he noted that the change in language about future policy was very meaningful, meaning that it looks like they purposely left it out in order to imply what may happen in the future. Let's look at inflation over the last year. As you can see, in June, it peaked at 9.1%. And why did inflation go up so high? It's because interest rates were artificially so low. If we go back to the previous chart that has to do with the cost to borrow money. And therefore, the cost to borrow money was less. Folks spent more, right? Because if you can borrow money at like 2-3% and then you can invest it in an asset that's making more than 2 or 3%, why wouldn't you do that? And then on the side note, like home prices were going up. And so homes are typically folks' biggest asset, and the biggest portion of their wealth is home equity. So even though you can't take home equity to the grocery store, when people feel like their home is worth so much, they're more likely to spend because they're just like, oh, I got so much money in my pocket, even though it's just in the house, right? Now, as the Federal Reserve raised interest rates, you can see inflation going down, and we're at about 5% now. Once again, the goal is to get down to 2%. So why would the Federal Reserve pause the rate hikes? Because all this information lags. Like it's not real time. Typically, it's like 2 or 3 months behind. So if we're at a downward decline and we're at 5%, it may mean that if things stay the same as far as rates, that this decline will still be going down because in real time, we may be at maybe 4% or 4.5% or 3%, something like that. I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas? No worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. So what really drives inflation, however, is the job market. When folks have jobs, they have money and they're more likely to spend more. When folks don't have jobs, they're less likely to spend more. So you may see headlines like tech firm XYZ, or I guess ABC, which is Alphabet, Google, are laying off companies. But those are big headlines and big name brand companies. But for the most part, the job market still is relatively strong. Here's another quote for you. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressure continues to run high, and the process of getting inflation back down to 2% still has a ways to go. So, unfortunately, more folks may have to lose their job in order to get inflation down to that 2% threshold. However, I would note that the election is last year, so it's unlikely that the current regime wants to see a bunch of people laid off before they go to vote. I do want to touch on some of the banking collapses. Here's what the Federal Reserve's chief economist said back in March. They said that a shallow recession is likely due to some of the banking issues. Just a high-level recap of some of the banking collapses. Basically, banks assumed for some reason that the interest rates would never go up. They bought a bunch of treasury bonds in Silicon Valley Bank situation, and then when the price to borrow money went up, they got cleaned out essentially due to bad quality management of their assets. I have other episodes on that. It'll be in the description if you want to check out a full breakdown on that banking collapse. I didn't explicitly state this yet, but if the Federal Reserve levels out the cost of borrowing money and, of course, decreases the cost of borrowing money, that's when mortgage rates will go down. Where mortgage rates go down, home prices go up because more folks like you jump off the sideline and decide it's time to buy. So, final word from Mr. Jerome Powell. Policy is tight, and that makes it possible the central bank has done enough to raise rates. So we'll see what happens in the future, but it looks like things may be getting better as far as interest rates in the market. Now, buy land, rumor has it, they're not making any more of it. All right.